Hi, I'm Jacqueline. I'm a retired Fortune 25 CPA that's retired and helping self-made millionaires save more money in taxes so they can increase their net worth. So let's talk about how taxes work when you file a 1040. So what is on a 1040? So when you look at the Form 1040, it's made up of a few different sections. And these sections are important because from a tax person, it tells me what I need to do to figure out how you benefit from the taxes. And this is where it gets really savvy when you're on the advanced level. So what goes on? You've got lines 1 all the way down to 10. This is what tells you your adjusted gross income, okay? So this is where a lot of the calculations need to know the adjusted gross income in order to calculate them. Like certain things like medical deductions on your itemized needs to know your adjusted gross income. Then after that, you can reduce your adjusted gross income by either the standard deduction or itemized, depending on which one is greater. These days, after 2017, most people have a standard deduction. And then you have your qualified business income deduction. So if you have any LLCs, anything that flows through, they're gonna come through this line if you get the deduction. The 20% for an LLC is not guaranteed, guys. So we gotta be real careful about how we talk about taxes because people like to talk in generalizations. So this is a calculation. This is where you see when people say, oh, if you have an LLC or business, you get 20% haircut. This is where it would come through, but that's not always guaranteed. This then makes you arrive at your taxable income. Your taxable income tells you how much your estimated taxes are, okay? So this is the first part where you calculate using all the tax brackets, married, filing joint, single, all the other ones that exist. You're gonna put them through there. Caveat on tax brackets, if you are separated from your spouse and going through a divorce, you do married filing separate. If you are husband and wife, you cannot file head of household and married filing separate. That's illegal. So don't do that. I see a lot of people do that. Don't do that. It's not right. Then your estimated tax can be reduced by tax credits. So this would be, stuff like child, solar, EV vehicles, those kinds of things. And then we're going to also reduce it by payments made. So this is when you have, estimated tax payments that you made, withholdings in your W-2. If you have a prior year that you apply to current year, it would come through here. And then this is where you get your net owed or refunded. Usually refunded is like a negative number, so you have more money than you paid. So this is like generally how you calculate. And this is important because it's going to tell you two things. And we need to really think about this. So this is an opening. So anything from this line up, we call an above the line deduction and impact. So all of this is before the tax rate has been applied. So this is above the line, okay? And anything from here down is what we call below the line. This is important because down here, if they say you have a tax credit, this is a dollar for dollar deduction, okay? Whereas up here, you need to apply your tax rate in order to understand the impact to your taxes. So the above line, you have to multiply by your tax rate, okay? And then when you apply your tax rate, then you know how much it's going to reduce your taxes. So there's a very big difference between what's dollar for dollar, so tax credit, like child, solar, EV vehicle tax credits. These kinds of things are dollar for dollar. So they're reducing one for one rather than up here, if you do depreciation, it's an above the line. We need to multiply it by the tax rate to understand how it impacts our taxes. So this is a really, really big difference that very few people really talk about or help you understand. The other thing that people don't help you understand when they're selling a product would be short-term rentals that they're going to sell you. It would be, and then they're going to manage. It would be people who are doing charitable deductions, people who are doing oil and gas, people who are doing real estate funds. all of those, we have to run through calculators, but more importantly, we need to know how they show up in order to know how much you can deduct. So you have to be really, really careful. And if you're a W-2 earner only, which is this top line is your W-2, if you make over $313,000 in 2025 and $626,000 married filing joint, if you make more W-2 than that, you cannot wash anything through here from a K-1. And that's really important for you guys to know. You're limited under the tax laws starting effective 2017. So back in the day, my effective tax rate in California was 2.5%. We didn't have these rules. We were on 1986 tax code. Now new rules have limited how much business loss can offset income. So we really need to be careful, and this is why you need to work with a tax professional to calculate this stuff for you. It's not as simple as putting your money somewhere and then you're hoping and praying you get the deduction, okay? So we need to be careful. The other thing you need to be really understanding of is that your income, this section gets divided into 3 categories of income and then a total. So over here, we have the total. This is important because this is the line, and this line here is going to carry against all the rest of these calculations. Until then, we have buckets of income. So you have active, you have non-passive, and you have passive. So all of these have different classifications, okay? And this is really important. I'm gonna do a different video on how you classify and all that, but basically you have to break this all up to know what number gets you across to your total adjusted gross income. And this is really, really important to understand because each one of these has different tax deductibility that you can apply to it and limitations. And this is super, super important because at the end of the day, this number here is what we start to reduce the standard deduction and the itemized. So you see the number here, and then your Q by reduces this number, red is negative in tax land, and then this gets you, ideally, a very low taxable income if you do it properly, right? And then you have all of these other items, then there's a tax number here that comes through, and then these ones here are going to reduce your tax bill when you file your return, because you've been paying throughout the year. The US is on a pay-as-you-go system, and so as you pay and you go, this is gonna reduce, your tax credits are gonna reduce, payments that you've already made, you're gonna get credit against the total estimated tax that you owe, and this is what you're gonna owe when you file your return. So at the end of the day, when I talk to people like, oh my God, I had to write a check for $90,000. I'm like, what was your total tax for the year? They're telling me $90,000. This is after all of these numbers reduced this number here. So when we do tax planning, we care about very important numbers. We care about what's your total tax before all of these reductions, and we care about your total income. And then I care about what bucket each of the categories are in, because this is the levers of how I do my tax planning. So if you're a business person and everything flows into here with an S Corp, because most people are an S Corps, you want to know where your tax credits are, because if you're employing a veteran, you can get a tax credit. If your business is in a certain zip code, you can get an opportunity zone tax credit. So it's really important to have the right person in your wheelhouse who can help you reduce just by operating the way you're operating. And that's basically how 1040s and their tax matters. And this is why it's super important to understand the 5 levers and what we're trying to do. Because most people try to plan off the total, and that's not how it works.